Good morning, everyone. Welcome to the Macro Snapshot. We are Tuesday, June the 17th, 2025, recording this at about 7:30 in the morning. Okay, so let's just see what's going on. Let's actually start off with oil because that's probably where the market's most sort of attention is. Well, this sort of the Iran-Israel conflict. Okay, so what's been interesting is that after the weekend, we saw that the futures open. This is a 15-minute chart, so relatively short term. We saw that oil spiked up just on that extra kind of escalation over the weekend. But then subsequent to that, you can see that here the WTI price has actually come down quite a lot. And yesterday it just sort of fell and fell and fell. But then what was interesting is that we had a Trump. This is the 6 p.m. gap overnight here. So you see going from 5 o'clock until the 6 p.m. open here. And what we had kind of two things. We first of all had Trump leaving the G7 meeting earlier, and then he posted some very portentous sort of comments, something to the effect that I've got a lot of very important things to get organized in Washington. I think he convened the National Security Council to get ready in the Situation Room, and also he basically said that everyone in Tehran should, quote, sort of evacuate, and that big things could be coming. So the market pretty logically, I would say, sort of interpreted this as possibly meaning that the US was considering some kind of sort of coordinated action with Israel, maybe even allowing Israel to use this huge kind of sort of 30,000-pound bunker busting bomb, which is really what is necessary to take out the nuclear sort of the uranium enrichment sort of plant. I think it's called Fardo, which is buried in a mountain. But that hasn't happened. But anyway, the point is that oil on those sort of headlines, thinking that something big was about to happen and some kind of major escalation. You can see here that oil went up from about 69.70, got up to about $72. So essentially just over a $2 rise. And then during overnight session, it's sort of come down. But then again, since about 3 o'clock, it's sort of kind of grinding upwards. So there's still a little bit of risk premium. And certainly, if we go back on a daily chart here. This is the futures continuous contract. You can see here that we definitely have come some way since, let's say, the beginning of June, but the spike here has happened, and we're now just sort of sitting back a little bit and essentially waiting to see if this de-escalates. And really, what the market wants to focus on now, or what the market wants to see, are there any supply disruptions? Is the Strait of Hormuz? Is there any small chance that could be closed? Are any refineries being hit? Are any sort of oil storage facilities on the island of Karg, where the Iranians keep most of their oil, are they being hit? And the answer to all of that stuff so far is a resounding no. Excuse me, just grabbing some tea. So the point is that at this moment, there is definitely still some risk premium priced into the market, but the market is slowly becoming less convinced that this justifies a significant sort of price hike. All right, so let's just have a look at a couple of sort of indicators under the hood, so to speak, just on oil before we finish up. So this is the curve of the WTI contract, and as you can see, it's still in a fairly strong backwardated state, which indicates, sort of quite strong demand, at least for the front end of the curve. And if we compare that to, let's say, a day ago, which is kind of interesting, we'll just put it up here. So the day ago is this sort of purpley pink line. And you can see that since a day ago, it is actually higher. So still, there's definitely some premium. But if we look at, let's say, a week ago, which gives us a bit more context, which is this yellow, the yellow indicator here. You can see that not only has the price gone up, the outright price, but also the curve has steepened a little bit more in a more backwardated state. So at this point, you'd have to say, the market is definitely still trading with some kind of risk premium, but maybe it's attenuating a little bit. So another way to look at that, let's look at a couple of time spreads, which have come off a little bit. This is the extreme front of the curve. So this is the front contract CL1, the prompt minus a CL2. And as you can see, both of their outright prices in this upper box have gone up. But what you can see is that as the price is kind of chopped around a little bit, the actual spread between them, again, this is a pretty short-term chart. This is a 30-minute chart, so going back 5 or 6 days here. But you can see in the last 2 or 3 days, we had the initial spike up to over $2 on the CL1, CL2 spread, and that's now come down to about $1.46. So it's definitely sort of sliding down a little bit. And then the same thing if we go a little bit further out the curve, not quite as much, it's a bit more stable. This is CL1 minus CL6. And again, you can see we had that initial spike in the spreads going up to about sort of almost $8. And since then, it's been a bit choppy, but essentially it is lower, and we're now just under $6. So it's come down about $2 or so. So definitely the time spreads indicating that there's just a little bit less sort of pressure on the front end of the curve. And then if we look at the call put skew, which normally, of course, is negative, there's more sort of downside. But we can see here that spiked pretty aggressively just when the whole thing escalated on the 12th of June, a few days ago. And you can see here that went up to about 17. The differential went up to about, oh, actually 18 was the highest there. And since then, it's been relatively stable, but it's definitely sort of calmed down a little bit. And now we're looking at a premium of the price of calls. So what this is basically the 25 delta calls versus the 25 delta puts and the premium. And what we can see is that the cost of upside protection, so calls, is definitely more, it's in the positive than the puts, but that has attenuated somewhat. So I think the thing to take away from it is that the market is definitely keeping an eye on the situation. Trump's, sort of relatively dramatic comments sort of yesterday evening definitely got the market's attention, but when there's no follow through, there's not much action. Having said that, there's not the all clear. Even as we speak this morning, there's definitely still sort of headlines that the Israelis and the Iranians continue to sort of send missiles at each other, and definitely the scope of the attacks from the Israelis has widened a little bit. I was looking at some stuff this morning now in Western Iran. They're taking out sort of media centers. And, I think this is definitely not over at this point. And there's obviously still the possibility of one further sort of escalation, which could be a direct attack on that sort of bunker. I think it's the Fardo sort of nuclear facility there, which is the ultimate goal of the Israelis, is to decommission that completely. We shall see. And for sure, if we get a headlines for that, oil will probably spike up another $4 or $5 at least in the short term. So, what we can keep an eye on that is then also just in terms of headlines and stuff. We do have the G7 meeting. Now, as I say, Trump left that early last night because he had very important business to attend to, which is possible. But that's put a bit of a dampener on the G7. Having said that, there are some sort of bit of information. It seems that there's no immediate chance of a deal between the Americans and the Europeans. There's no immediate chance of a deal between the Americans and the Japanese. On the other hand, it does seem that within the next 30 days, there could be some kind of sort of trade and sort of defense cooperation kind of accord reached between Canada and the US. So that looks as though that relationship is going quite well. And there was a further small trade agreement between the US and the UK. So at this point, I think the main thing just to step back is that still between the US and Europe, there's nothing really concrete. And between the US and Japan, there's nothing concrete. And between the US and China, there's nothing sort of particularly sort of concrete. So at this point, the whole world is still in suspension. And that's where we're at the moment. So you see that the volatility has gone down quite a lot. Okay, so let's just move on also to data. One thing which we just got, which I just want to quickly draw your attention to, we got the in Germany, the ZEW investor expectations, and that actually was higher than expected here. You can see it came in at 47 versus 35. So again, this means that there's a little bit of confidence in Europe. It's not all doom and gloom. And in terms of the ECB, if they continue to get, this is just a survey, but nonetheless, if the sentiment, is a forecast of maybe what's going to happen in the real economy, that gives the ECB more sort of reason just to sort of stay pat at the moment and not do any more cuts, at least for the next meeting or two. Over in the US, we're starting to get some interesting sort of real data here as opposed to surveys. We've got the retail sales. Now, this is preliminary data for May, so that's kind of interesting. And keep in mind that this kind of data has been pretty strong for the last 2 or 3 years. We've had strong sort of wage growth and wages over the last 2 or 3 years in the US. We've had strong household spending supported by strong wage growth. So really what we're trying to figure out, and what the economy is the market's trying to figure out is, is there going to be any signs that the US consumer is sort of losing their ability to spend or their desire to spend? And I was looking at some data this morning, essentially showing that sort of the pace of wage gains is actually attenuating a little bit and is sort of slowing, as is sort of household spending. So let's see if this starts to turn up at this point. This is probably going to be a multi-month slow grind, but it does look as though this is slowly deteriorating a little bit. So of course, let's keep an eye on this. The key ones to look out are the retail sales excluding autos and gas excluding autos, but also like to look at the control group, which excludes automobiles and gasoline prices, but also sort of some home improvements and a few other ones. So that's really the super core in a sense is the control group. And as you can see, that is expected to be an improvement over last time. As always, it's quite a choppy number, so let's keep an eye out for revisions. But that could give a little bit of market direction as we head into the Fed tomorrow. Okay, talking about the Fed, let's just quickly see where we are with pricing. Again, as always, we're just sort of hovering around about this two cuts level, 1.98 as we speak, basically 49.6 basis points. So essentially two cuts priced. We'll talk about that a little bit more tomorrow morning, just do a bit of a Fed preview. But that's what the market is expecting. Quite a few commentators are saying that there's a good chance that the Fed might actually reduce the dots just to one, although I don't really see some benefit because that would be a significantly hawkish kind of developments, which maybe just would provoke volatility, which is maybe not the goal of the Fed. Okay, just in terms of some other news, let's start looking at a couple of charts here. Put it back on the daily. So we looked at oil. If we go and look at the VIX, we can see that the VIX has gone up a little bit, for a long time, last couple of weeks, it was sort of grinding down towards, 16, 17. Definitely with what's going on in Iran, it's spiked up a little bit, but of course we're miles away from these very volatile levels around the tariffs and whatnot. So, we're sort of around about 18, 19, 20 rather than sort of 15, 16, 17. So definitely not at sort of historic lows, in the low teens. But certainly nothing particularly, earth-shattering at the moment. So that sort of relatively low volatility, although as I say, it has spiked up. Well, I don't spike is the wrong word. It has climbed a little bit over the last couple of days, and you can see here that the ES futures here. This is the continuous contract. Remember, we had the roll yesterday, so there was a little bit of confusion there, but had the roll now in the September contract. You can see that this is sort of grinding its way up to testing the highs here at about 6100, 6150 or so. And to be honest, that's probably going to be determined the next move by the Fed. If the Fed comes in sort of relatively sort of dovish tomorrow, for sure, that can maybe retest the highs and maybe break through. On the other hand, any sort of hawkish and negative surprise from the Fed, of course, could get that sort of coming down. We shall see. Similar situation for NASDAQ. If we just look at the bonds, let's just look at the 10-year here. What's kind of interesting, if we look at the 10-year and let's say the ZB, uh, uh, a lot of the sort of the logic goes to say that if oil price goes up, that is technically at the margin a little bit inflationary, which is a negative for the long bond, and that's absolutely true. Although I was reading something yesterday, and the fact is now also that the U.S. is a net exporter of oil, and so that old relationship of an oil spike is bad for the U.S. economy and bad for the U.S. dollar, it doesn't actually hold true anymore because, as I say, the U.S. as a net exporter since for the last sort of 7, 8, 9 years or so, since Obama lifted the export ban, I think in 2015, was it, or 14? Essentially, that's not so bad and maybe less inflationary as well for the US. And as you can see here, the bond market it's getting a little bit of a tick up today, but the last couple of days has been going down. So maybe there were some fears about the inflation fears of generally speaking of oil prices, and as oil has just sort of come off the boil a little bit, just a little bit of tick here yet. But still, what we have to say here is that, like for example, the ZB, this is the Fibonacci retracement here. It's definitely still in a little bit of a downtrend, we would have to say. Let's just throw in some indicators here. So the EMAs, you can see here that the EMAs are all sort of still pointing for downwards momentum, and it was rejected here at the 100-day EMA, which also coincides with this of the most recent impulse, the 61.8 fib retracement here. So that's still looking sort of a little bit negative, and could this, just from a technical point of view, a chart point of view, be some kind of sort of bear flag that potentially has a little bit more downside? We shall see. Oil we looked at just in terms of the US dollar. not a huge amount going down. Again, this is still very much in a downtrend. As you guys can see here, it was rejected at the 61.8 fib, or was it the 50% fib, back on the 12th of May. All of the moving averages are still looking negative. So there's still not a lot of positivity. And even with the geopolitical strife, which we've been witnessing, you can see here that you could hardly call this a rally, and certainly not a sort of a flight to safety. So I think, any kind of weakness in the data, maybe retail sales today, or maybe a slightly more neutral or sort of a dovish Fed tomorrow, we could start to see this sort of double top retested down here at 97.75. Let's have a look, because that could get down there, and once it goes down there, that could break down then to 96 and a bunch of other levels. Just in terms of other currency stuff, we did have the BOJ overnight. Not a huge amount. There's obviously no hike. But also what the market had been focused on was the tapering. We know that the BOJ has been buying historically for the last 20 years an enormous amount of Japanese bonds. They now own, I think it's about 52 or 54% of the Japanese bond market. So they're looking to taper, to basically to slow the pace at which they are buying bonds. And they had been doing that at 400 billion yen per quarter, but they're a bit worried about sort of some of the volatility in market functioning. And so last night they actually have reduced that taper down to 200 billion. So the point is that that's technically a little bit bullish, because that means that they are, how can I say, reducing their reductions rather than by 400 billion per quarter, by only 200 billion. So it's a little less aggressive. But the market had a forecast of 200 or 300 billion of yen per month. So that wasn't a huge sort of problem for the market to absorb. What was interesting, though, was that in the press conference, Ueda, the governor, he did say, and I got the quote, was the downside risks are now greater than upside risks to the economy in general, but also prices. So that's probably a little bit sort of soft and a little bit dovish. And you can see here, the yen didn't particularly gain too much strength here against the dollar at all. So pretty flat here, but certainly not gaining. So at this point, I just want to say on the yen, I mean, it's just been trading in a sideways range now for quite a long time. Just hovering, sort of in a range between like the 20, 50-day moving average here, going a bit sideways. Nothing horrible, but certainly not showing any signs of further strength and wanting to sort of test down to the 140 mark for the yen. So if the yen is to strengthen down here, or the US dollar to weaken against the yen, as I say, maybe the next sort of impetus for that will come from, start to get some hard data starting today, but also we get Powell, of course, tomorrow with the Fed. Let's keep an eye on that. Just finally, guys, having a quick look over at gold. We can see that gold here, not a huge amount. This is still a very, very bullish chart. All the moving averages still moving up. You can see that we're getting higher highs, or dips have been bought, higher lows, all that kind of thing. So at this point, just to, I don't know, I guess we could call that a one-day sort of retracement here. But essentially, gold is still looking strong at the moment. No reason, if you're in that trade, to exit. If you're in a momentum trade, on the other hand, it is a little high just to enter that trade at the moment. Okay, I'll leave it there. I have retail sales at 8:30. Let's see what Trump has to say. And of course, let's keep an eye out on any possible major escalations or developments in Iran, Israel spat. Okay, thank you. Have a great day, and we'll keep the conversation going. Thank you.